Hello, everyone, and welcome back to another episode of Spark Your Fire. Last episode of the year. John, excited?
Yeah, I'm excited. I'm hot too. We both look like we're in t-shirts and boxer shorts, so it's a warm day. But yeah, it's been a good year.
Probably the most unprofessional looking for the time being. Ever since we moved to video this year as well, by the way, we made good progress last year. Certainly earlier this year we started moving on to video, so people can now see us as well as just listen to us on podcasts. So that added another level of complexity. I think you were quite resistant initially about getting onto the camera, but done very well. So here we are. All right, last episode of the year, but certainly still packed with contents, let's put it that way. Okay, so
yeah, that's right.
December cash rate, let's start off with that. So December cash rate was a hold at 4.35. I think RBA certainly want to give us the Christmas present early. To a degree, I think most of the economists are pretty consistent in terms of saying it's going to be a hold this time. The CPI data last month came down to be a lot weaker than what people have expected as well. So on that note, inflation might be trending down a lot faster than we all anticipating. Fingers crossed. As again,
I might just come in there. I actually most economists, I think, were saying that they would move in December. But right at the end changed their mind. So it was around October. There was like, oh well, there's got to be 2 more rate rises, Melbourne Cup and then December, and I think that the change in consensus was quite a late change.
Yes,
I think we discussed that they wouldn't, but I don't think that was consensus at the time.
Yeah. No, so I think you're right. Thinking about the narrative, when November was up, they were certainly thinking there's a possibility with December as well.
Yeah.
But after the November CPI data has been released, that's when they started changing and say, no, it's weaker than, so, we're probably looking at the next year. So, which is good in a sense. But I think the RBA still kept the hawkish tone at the moment. So, Michelle Bullock is still stating the same. If required and if the data tells us to, we will not hesitate to pull another trigger. So that's why they're leaving that space, and, economists are thinking, because the next meeting is February now. And by the way, they're only going to do 8 meetings next year. They're changing to the new system now. So it'll be interesting to see how that goes. But the first meeting is going to be February. And also they will have the quarterly CPI data available at that time, which I think will be a lot more meaningful. So let's see how Australians fare at that point, whether they're still spending spree like crazy over Christmas period, or whether they've decided to cut back because the impact of the rate increases are now starting to hurt.
Yeah. We'll see. I mean, my view is that the 10-year yield, they say the bond market never lies. You can have property prices going up, you can have stock market going up, but what's happening in the bond markets is the most the best indicator.
Yeah.
Over the last month in the US, at least, the 10-year yield, you've got to watch the 10-year yield. The 10-year yield has really plummeted, which is to say that interest rate expectations in the US, at least, have changed completely. The inflation numbers are low. The 10-year yield's down to 3.2%. So to lend for 10 years, you're going to make 3.2%, which is very low, suggesting that potentially rates are going to start getting dropped in March in the US, at least, and we're about 6 months behind them.
Yeah.
So I don't actually think that they will reduce them in March, but that's quite early. I mean, that's suggesting that the bond market, which is the North Star, is suggesting earlier rather than later rates will come down. And I actually think that, the interesting thing about a recession is you don't know you're in a recession until you're out of it, because it has to be 2 consecutive quarters. That means it takes 6 months to experience the recession and then a couple of months to report it. So you're out of the recession by the time they report it. Oh, you were in a recession last year. So I actually feel like we're probably in a recession right now. And then by April, they'll be reporting that. April, May, we'll know. In which case, they're going to start to bring rates down. I do think that the US will bring rates down first, let's say May, June, and then we'll be doing it a couple of months after that.
Okay. Yep. that'll be promising. But there's still a chance that it could still go up in first half of 2024. Let's put it that way from an Australian RBA perspective. I think one of the key things to note from memory was she has noted that the inflation figures right now is locally driven. It's not because of import or anything, not because fuel price and all those things. It's actually the demand. So there's still too much demand locally at the moment. That's what's driving, or that's what's making inflation at the moment still stickier. So it's local now.
Well, the oil price went below $70 a barrel this week, just I think on Wednesday or Thursday. So that's, I mean, we were saying how low the oil price was when it dipped below $80. When the inflation concerns started to emerge again, which is about 2 months ago, oil was at about $90. So oil is about $69 a barrel US now. So that's a significant decrease. Now, some of you listening may say yes, but oil prices are excluded from core CPI. You are correct, but oil is the key ingredient in about 2,000 goods, including the clothes we wear. So it makes a big difference. So yes, we might be talking about. I remember Grant Cardone said in June thereabouts. Now Grant Cardone is that big kind of bombastic property guy in the US, but he's quite interesting. And he said that in about June, he said a year from now, so in 6 months from now, he said that we'll be begging for inflation. Well, wait and see.
They've gone too hard. They've gone too hard.
Yes.
And the narrative's changed from higher for longer to higher for long enough. I think that's the narrative now, isn't it?
Well, the interesting thing about the oil prices, that OPEC keep cutting supply and the price keeps dropping, which means the underlying demand is falling off a cliff. If underlying demand for oil is falling off a cliff, the economy's in a bad state. They can't cut production fast enough to stop the price from falling. So again, there's a lag in the statistics, but in March, we might be talking about this steep recession that we're in. I mean, the oil price is telling us something. Oil price, the 10-year yield, it's all sort of coming together. That there's a lot of demand destruction out there. So, we'll wait and see.
Interesting. Yeah, we'll definitely keep an eye out on the on those core figures moving forward. But I think 2024 is going to be an interesting year. That's for sure. And that's basically our key topics for today as well. So, what we'll do is we'll run through the CoreLogic data as what we do and use that as a bit of an analyst and catalyst to talk about the 2023 property market in Australia. And then we'll also do a bit of a forecasting or what we think 2024 is going to be like. So, all right. So as usual, let me just share my screen and we'll run through our CoreLogic data figures for November. Okay, all right. So here is our November figure. Here, John, can you see the screen? Just checking.
I can.
Yes, fantastic. Okay. All right. So look, the key headline, there's still growth in November figures. However, it's starting to slow, basically, is the key narrative here. Okay. So, and we're returning into a multi-speed type of condition. So, the bigger cities which are more prone to interest rate rises, which, after the Melbourne Cup day rise, I think everyone's had another shock of that. So the Sydney, Melbourne cities, which are more prone to interest rate increases, are now certainly started to see the speed slowing down, the growth slowing down. As we can see, the month for Sydney is now only at 0.3% and Melbourne is at a minus 0.1%. Whereas the other cities, less impacted cities and the more affordable cities, Perth, Adelaide and Brisbane still had a really strong gain. So Brisbane 1.3, Adelaide 1.2, Perth a stunning 1.9% of the month. So these are less impacted by the interest rates, and so I think we're going to continue to see this moving forward, basically as the interest rate environment remains as is through 2024, unless there's potential cuts coming on. Otherwise, there's probably not going to be much changes. Yeah. So, any comments on that, John? Any thoughts in particular?
So, I mean, the big growers, Brisbane, Adelaide, Perth, I suppose no surprises for me other than Adelaide. Adelaide is just seems unstoppable. So maybe we'll come to that in the 2024 review. I guess my footnote would be that Sydney at 0.3% is the slowest growth we've seen. The peak growth was back in June, actually, which is quite a long way away in the rear vision mirror, where we were growing about 2% a month. December, and we're about 9 days into December, so December will be lower than 0.3% because I track the daily indexes, and it is going up and down some days. So I think that we'll have like 0.1% growth in December, and then it's anyone's guess for next year. But what a cracking year for real estate.
Indeed.
What a cracking year. If you look at that annual column, I mean, what a great year. What a fantastic year for real estate. So
yeah, I know. It's amazing, isn't it, when you look at it? Certainly Sydney at 10.2% on an annual basis. That's phenomenal. Like, I think last year around this time when we did it, Sydney market was pretty dead. Yeah, because that was just when we started to raise the interest rates and everyone started to go, oh, what's going on, right? But despite the continuous increases in terms of the cash rate, Sydney did not stop this year. That was definitely one of the biggest surprises that I think most people did not expect. However, one person did expect that, John. One person.
you were reviewing our December 2022 video, and we said that the two best performing markets would be Sydney and Perth. We're wrong about the ranking, but I mean, geez, we got the direction right. And
got the direction right.
Yeah.
So I certainly didn't see Sydney being so strong at that point in time. But I was checking out our December 2022 recording, and I remember, you did mention you believe Sydney and Perth are going to be the two strong performers in 2023. So look at that, 10.2% for Sydney on an annual basis and 13.5% for Perth on an annual basis. So well done.
Yeah, I underestimated Brisbane. Sydney outperformed Brisbane in the first half and then underperformed Brisbane in the second half. Brisbane's, I mean, maybe the story is that Brisbane has legs until the Olympics. I mean, maybe that's the story. But my guiding light is the ratios that we do. We do those videos where we compare real estate to gold, and then the capitals to each other. 2, maybe 3 times at the most per year. So we'll probably do that again in March. But I kind of thought Brisbane was a bit overvalued during the year, and yet it cracked on. So it's done very. So Brisbane, a little bit surprising, but it might have legs for a few more years.
I know it's surprisingly strong at the moment in terms of the market and on the ground, especially when I look at the median value as well. It's pretty much on par with Melbourne now. 2023 is being a catching up year for Brisbane, but at the same time, it's been a disappointing year for Melbourne, I should say. Sydney has had another leg of upwards trend across 2023. That's not been seen in Melbourne at all. Melbourne's been very subdued across the full year. So I think that's still partly to do with the policy makers, and Melbourne, unfortunately, still have one of the worst yield, just pretty much on par with Sydney now at the moment on that. So that's turning a lot of investors away. So if you look at those areas, a lot of the investors buying pretty much in Perth, Adelaide, and Brisbane. These investors are actively working on these 3 markets, whereas you probably don't get any investors in Sydney and Melbourne at the moment.
Not interstate, certainly. I mean, you get local investors, but
local investors, yes.
But you don't get someone from Perth calling and saying, "John, I need to, that 2.6% yield is really compelling. Can I buy an investment property in Sydney?" No, that's not really happening.
No.
What I like about this chart is the total returns. It really does put good context into what your overall return is. Including the rents. And we all, I do it too. We all ignore the rental returns because we're in it for the capital gain. But it's a fantastic reminder that actually real estate's doing magical things. It's not just the gains, it's the total return and the leverage. So if you did those returns against your upfront deposit rather than on the nominal value of the property, you're making 50% a year.
Amazing.
That's one way to look at it.
Yeah. No, that's true. That total return column certainly it deserves a lot more attention than than what we normally do. That's for sure. But yeah, I think yeah, this is the year for Perth. That's for sure. I think undoubtedly, looking at that, and my personal feeling is still going to continue on next year as well. I think that chances are it's going to be one of the top performers as well. That's for sure. So,
well, we're going to put our necks on the line shortly and come up with our top performers. But yes, we have to.
Do you need me to prepare something for you, John, in order for your neck to stick out?
I'm gonna wing it, but let's we'll do it. We'll do it in a moment.
All right, mate. Let's continue on.
Yeah.
Hedonic home value indexes, rolling 3-month changes. Okay, so that gives us a bit of housing values through the recent cycles, previous peak trough. I mean, I'm not going to cover this. I think most people can probably look at it themselves in that sense. Okay, so there has been a rise in the vendor activities, basically, especially in Sydney and Melbourne markets, essentially. So the stock levels, the new listings, the stock level has been going up consistently for the last month across to spring. So if you look at the 4 weeks ending November, the advertised stock level above the previous 5-year average in Hobart, Canberra, Melbourne, and Sydney. So we've always had an issue of lack of stock, I think, in the first half of 2023, but now that's starting to catch up. So the new listings are pretty much on par with the 5-year average now. Okay. But the same can't be said for Perth, Brisbane, and Adelaide. So these 3 cities, advertised stock levels remains remarkably low. Okay, Perth actually is about 40% below their 5-year average.
Right.
This time of the year.
Right.
There is nothing to buy there. There is absolutely nothing to buy.
Yep.
Listings while listings are more than minus 30% below average in Brisbane and Adelaide. So these 3 cities, there's a reason why these 3 cities have performed so well. There's literally no supply. There's nothing to buy. There's a lot of demand because of investor activities, basically, because you're getting decent yields, decent capital growth prospects moving forward. So, that's the reason why it's pushing it up. Where Sydney and Melbourne prices, or Sydney and Melbourne supply at the moment has been quite high. There's a lot more properties coming up, but the rental return and everything. So it's not something that the investors will be looking at. So, but it's fascinating.
Just a quick, the media make a big deal out of stock going up, and I'm totally unimpressed by it because, as you and I have discussed, it's not population adjusted.
Yes.
The fact that we've got the same volumes as 5 years ago, it would be, I suppose, a signal if we had the same population as 5 years ago, but we've got significantly more people.
Not the same now.
And it's great. Yeah, like that the supply can't keep up. What should be happening is every year that supply goes up to have a balanced market. So I think that the closest thing that we can get to population adjusted supply is actually over on the rental side, which is the vacancy rate.
Vacancy rate, yeah.
And the vacancy rate's staying super tight.
Yeah.
But yeah, it's good to see ticking up a little bit in spring and summer, but I don't think we've solved our shortage problem at all. No,
that's for sure. And also on the demand side as well, it's worth noting that, despite the high cost of the debt and the very pessimistic consumer sentiment, the purchasing activity has actually held reasonably firm. So people are still wanting to buy, needing to buy. So so the quarterly sales activity holding roughly in line with the previous 5-year average as well, while regional demand is trending modestly higher from below average levels. So I think that kind of tells us, yes, like you said, John, we're having a lot more population in here at the moment, and the demand, I think it's probably due to that due to the fact on those, that's why the demand has been kept relatively on par with us. Yeah. So a lot of supplies on average demand on especially capital cities, all those Sydney, Melbourne, Hobart, Canberra, those cities. That's why it's probably going to be going pretty flat moving forward. All right, moving on. So this is your favorite part, John, looking at vacancy rate. Sticking at 1% now in November, okay? 1%. Adelaide's at 0.3%, Perth at 0.6%, Melbourne at 0.8%, and Sydney at 1.2%, Brisbane at 1.3%. So with an average of about 1%. Extremely tight. Nothing to rent. Nothing to buy.
Yeah, Melbourne looks to me like a 2-litre bottle of Coke that's been shaken up. Like there's a lot of demand in Melbourne for dwellings at least, and the vacancy rate's saying that there's a massive imbalance. The prices are going down. It's partly the policy settings, and it's partly that capital goes to where it's treated well, and it's not treated well in Melbourne. But there's clearly a shortage, and I feel like it's gonna pop because clearly there's a shortage there. So we'll see again. 2024 conversation coming right up.
That's right. Yeah, and rents been consistently rising as well since August 2020. So it's been 40 months basically. So for the last 3 years and a bit more. And the rents has been continuing pushing up because of the fact, I mean, we can see from this graph here, it was literally just basically going down. So as you open the floodgate with migration, I think that's expected, but at the same time, there is no supply. And, we're just not building new dwellings fast enough at the moment to be able to cater for that. So this 2-litre bottle Coke situation, I think it's going to continue on for a lot longer, unfortunately, across a lot of cities. Adelaide 0.3%. I've never seen a figure that low.
Yeah, it's insane. That is insane. Perth at 0.6%. So, but at least Perth's and Adelaide's growth is reflected in the figures. At least you can see that there's clearly a shortage. Melbourne's going backwards, and the supply is getting tighter. So but Sydney and Brisbane at one point, they're unusually low. They're just higher than the rest. So
correct. Yes, that's still very low from a historic level. So looking from that perspective, all of Australia is actually under a pressure cooker right now. So that's for sure. All right. November also marks the first time in 6 months where rents have risen at a faster rate than home values. So this one will be interesting to you.
Expect that to continue. Like that's definitely going to happen. Yeah.
So the rent pressure cooker is going to continue, but the prices have started to ease to a degree. So I think it will be investors might be rejoicing with a higher gross rental return potentially in 2024. Potentially.
So what we haven't seen is yield normalization yet. So we've got, I think that at the peak of the market in 2021, the yield on a Sydney house was probably 1.9%, and now it's 2.6%. So it's shifted a little bit. But what should happen is that the yield in real estate should go to the borrowing rate. So the yield needs to go to 5%, let's say, round numbers. We're miles away from 5%. So rents, I wonder if rents have even started their reset higher. They have to double from here in let's say a couple of years. They have a long way to go higher for the yield to reset. The other way that could happen is if prices fall. So if property prices come down and rents go up, that's how you can get that normalization of the yield. But the yields are way out of whack compared to interest rates. So there has to be some adjustment. Prices down, rents up. But I just don't see prices coming down materially enough to change that. So it all has to be higher rents. I think that's just going to keep happening.
Yeah, it's terrible news for renters, to be honest. It sounds like, every time when the rent's being renewed, it's still going to continue to go up and up and up. And this year's been some jaw-dropping rent increases that we're seeing across the board, right? It's partly due to the fact the interest rate's been going up so quickly as well. So that's that cost is being passed on to from landlords to renters in order to be able to hold on to the properties. But I do agree with you. I think I don't see that it's going to be a lot of reduction in terms of the prices or the values moving forward from a property value perspective. So in other words, the rent's going to have to continue to catch up. Which is
so the average investor's seen their mortgage repayments go up by about 75%. And the average renter has seen their rents go up, let's say, about 15%. So there's a lot more stress on the landlord than there is on the tenant, even though there's stress all around. Like, I'm not belittling anyone's pain, but my guess is, because markets are a weighing machine, as Benjamin Graham said, that they're weighing things. You go too far to one side of the boat and then it tips and so on. So it's weighing constantly. Rents need to go up a lot more to equilibrate what's happened in interest rates. Is my guess. Yeah.
Or the other,
everyone's a renter now. Like, we're too far on one side of the boat because buying has been made too expensive. So,
or the other potential is if Fed does start cutting rates next year, then rates could be coming down as well as part of that normalization process.
Yes.
So yields will be moving closer. Let's say, for example, if cash rate does come back down to about 3.5%, and interest rate goes up to about 5%, then that the gross rental yield at that point in time, the rent doesn't need to go up, the prices doesn't need to drop as much in order to get closer to that mortgage rate that people are paying. That's another possibility as well.
Yeah, that's right. In which case, that's the cap coming off the Coke bottle a little bit. So that'll release some pressure on rents if they lower rates.
Yeah. Interesting. Okay. All right. Okay. So looking at a few summary points here. So CoreLogic believe that it is looking increasingly clear that housing market is moving through a new inflection point, with the rate of growth in home values becoming more diverse, but generally weakening. So Tim Lawless stated that the upswing in housing values since February has been relatively thinly traded and occurred against a backdrop of low inventory. I do agree with that. I think there was very, very little stock for the first half of the year. And then he continued on saying, the factors that have supported value growth are losing their potency, with advertised stock levels rising to above average levels in some cities, namely those Sydney, Canberra, Melbourne, Hobart. Those are the cities that we mentioned before, basically. So those cities are going to be performing relatively weak in moving forward. So that's basically, it's interesting that you're saying it's a new inflection point. John, what do you think? Do you think that we hit the new inflection point now?
Well, I mean, everyone feels like we're going into a new phase every December. There's a sense that this happens. So clearly the rate of increases has slowed down. When the market's not trying to catch up the 2022 losses anymore. That's true. We've entered a more normal market. I think that's fair enough. I mean, partly interest rates on pause allow the market to catch its breath. So the market is sort of figuring out what's next. But when rates are going up by 75 basis points a month, as they were a couple of months ago, the market's sort of discombobulated. But now, yes, we're probably entering a new market because we're on pause on the interest rates. So we'll see. We'll see. I think bull markets and bear markets go for long periods of time. I think they're decade long, actually. So changes from one year to another, not necessarily indicative of a bull market ending or another bull market beginning.
Yeah.
It's just I just think we zigzag up over time. That's what I think within a bull market. I still think so. Yeah. Let me put a cherry on that.
Go for it.
I think we're still in the same bull market, and we will be next year.
Okay,
but it won't go up as fast.
Yeah. So there will still be growth, but it's just going to be very moderate growth, not as strong as this year.
Yeah. No urgency to catch up.
No urgency. Yeah. And it also, come to think of it, also in terms of the inflection point, certainly the cash rate in US has now hit the inflection point on that side of things. And same thing with Australian, we're probably about 6 months behind them. So who knows? We might be at the top of our current cash rate already as well. And it might not be, might need to be another 0.25 or even another 0.5 on top of that. But let's see. All right. Adding further downside risk to housing activities of worsening in housing affordability. I think that is absolutely true. Affordability has been a key issue, especially in Sydney, Melbourne as well. I think Sydney in particular. Yeah. The median dwelling value to income ratio rose to 7.5. The portion of household income required to service a new mortgage is close to a record high at 46.2%. That's an astonishing figure.
Yeah, it should be around 30%. Like if you go back decades, it's always around 30-35%. Yeah.
So on average, 30-35%. Now we're sitting at a record high of about 46%.
It's high.
Yeah. No wonder like people's savings buffer is dropping like crazy at the moment.
Yeah, that's right. That's right.
It now takes an average of 10 years to save a 20% deposit. Poor new generations. I feel for them, that's for sure. And the portion of household income dedicated to rental payments has risen to 31%. So renters are also suffering at the moment. And that number could easily go up and continue to go up next year.
Yeah.
As well.
I mean, it's so tempting to say the problem is high interest rates. That's not true. The solution is high interest rates. The problem is that they did it that quickly. And the problem is that the problem is we talked about the party versus the hangover last week. But the problem is that they should never have dropped them as low as they did during COVID. I mean, that's that. So restoring interest rates and restoring saving rates and all those sorts of things is the right thing to do. But they did it in such a ham-fisted way that something is almost certain to break.
Yeah. No, that's true. In fact, to a degree, I think even some opinions were like RBA hasn't actually done enough and fast enough. That was the main thing. I think they're certainly what they're trying to do. They're trying to take the conservative approach. They try to do adding a little bit, see what the market reacts, see how everyone's reacting and that kind of stuff. If they've gone from a very like what Fed has done, such an aggressive increase in the last 12 months, I think the market is basically the property market will be standing in a very different position today. But the inflation will be coming down a lot faster. So it will be similar to the US trend. It's going to be up a lot quicker and down a lot quicker as well.
Yeah, that's right. I mean, the key indicator is actually real interest rates. So when we were raising interest rates and we were going from sort of 2 to 3 to 4%, inflation was 8%. So we still had negative real interest rates. And everyone's wondering why the real estate market's going up. It's because when you have negative real interest rates, they're paying you to borrow. We don't have that at the moment. We've got very high real interest rates. So we've got what is essentially inflation at very low levels, but now very high interest rates. So it changed very quickly. And now this is why there's distress now, but there wasn't distress in, say, June.
Yes.
When they were raising rates.
Okay. All right. So affordability is certainly something that we should keep an eye out on moving forward. Unfortunately, it's just not getting any easier for anyone, both the homeowners and the renters. They also did mention rental condition is set to loosen, which is slightly different to yes and no. It is going to. I mean, what our perspective is, it's going to continue to go up, but it's not going to go up at the sharp rate as how it has been performing this year, as well, isn't it? So, and CoreLogic's view of that is because it's likely that we are moving through a peak in net overseas migration. Okay, so in other words, the overseas migration peak has passed us now. But other factors should see vacancy rates starting to rise and rental growth slow further, including a gradual normalization in household size and reduced rental demand as home builder completions flow through.
Yeah, are there a lot of home builder completions? It depends what we're completing. I think we're completing a lot of one-bedroom units, so for students. So we'll see. I mean, I think we're still in a shortage for rental, and the yield conversation from before, rents have to go up.
Yeah, just that the rates to see where they're going up is going to be, I think, what to watch out for moving forward. Okay, and so overall, housing value performance is likely to be softer next year relative to 2023. WA and Queensland look well placed to outperform the rest of the country, given solid interstate migration rates, low supply, and less affordability challenges relative to Sydney and Melbourne. So that's in line with basically what we believe is going to happen as well. So,
cool.
So that's pretty much in a nutshell. I think, John, you did think there was one thing that you mentioned in December last year. You think that the unit growth is going to outperform houses.
Yeah, I was wrong on that. Yeah. So in terms of like what surprised me, and I'm going to ask you the same question, but in terms of what surprised me, I thought units would outperform.
Yep.
I remember distinctly saying that at the end of last year, that I thought units would have a good year, and I think that they just did, well, but slightly worse than houses. So I guess I'd predict that units will outperform next year, but I keep expecting that to happen. Yeah, that's what surprised me. I think in terms of the capitals, I think probably Adelaide's strong performance surprised me. Although when you look at the vacancy rates, doesn't look like that's going to stop. But and Brisbane surprised me. They were doing quite well. I think they're the best capital in 2022 and possibly 2021 as well. So I'm surprised that they had such a good year as well.
Yeah, no, that's for sure. I think everyone was quite surprised in terms of Sydney, and I should say that's probably just me. But circling back, looking at the unit growth. Let's just do a quick comparison. So Sydney units was doing on an annual basis 7.1%. Houses was 11.5%. So okay, well, Sydney's units didn't perform that much. Melbourne capitals 2.5%, and houses at 3.3%. So not really. But Brisbane 11.3% annually for units, whereas 10.6% for houses. So there you go. Units have actually done quite well in comparison to houses. And funny enough, because you did mention, generally speaking, when we buy in Brisbane, we'll be looking at buying houses over units, right? So,
and Sydney house prices, Sydney house prices beat Brisbane house prices, so that's
it's true on an
whatever that means. Yeah.
And Adelaide's pretty much the same. Annual for units 8.8 and 7.4% for capitals, and Perth 10.9% for units, and houses has done a stunning 13.8%.
Yeah. Go Perth.
There you go. So all right, but so I think that's good. You certainly there's a few surprises for us in 2023 from a recap perspective, but shall we talk about 2024?
Let's do it. Let's do it. Right. Who wants to go first?
That's always the case. Who go first? Who went first last time?
I don't remember, but maybe, I don't know, flip a coin or rock, scissors, paper, or maybe.
Okay. So 2024. All right. Let me put my neck out then. My short neck. Okay. So top performers. I still think Perth is still going to be number one. Perth, Brisbane, and I'm going to chuck Adelaide on as well. I think these are still the relatively affordable. I'm playing safe here, of course. But
which would be the worst performer, do you think?
The worst performer. Are we including or excluding Darwin?
Oh, we're including Darwin. That's a good point. Yep.
I'd probably put Darwin in that sense.
Right.
But yeah, I think with 2024, Sydney will be slow and steady market. So maybe around, I don't know, 5 to 10% or even less, to be honest. Maybe more around the 5%, closer to the 5%. It's still going to continue to stay as is. We're not going to see crazy numbers what we see this year. Certainly not a 10% growth and not a double-digit growth. But I think a key factor here that could impact that is depending on how quickly RBA starts dropping rates, because that sentiment change is going to light the fire on different markets, and Sydney being one of those that's more impacted by the interest rate changes. As soon as the sentiment starts to change, I think Sydney market's going to rebound very, very quickly again in terms of that. So So the interest rate decision and reduction, as well as the sentiment change, is going to have a big impact in terms of the Sydney market, and again the Melbourne market as well.
Yep.
Because don't forget, I think Melbourne market, like you said, it's a pressure cooker situation right now. And one of the surprises in 2023 that I had was a Melbourne market actually has not performed at all. It's just been subdued the whole year, right? But it can't remain that way. Like, it's still the number one net immigration from overseas migration capital. There's so much demand in that city at the moment, and it can't be subdued like this for such a long time, right? And with the goal comparison that you've done, it's clearly showing that Melbourne is now undervalued, and there's going to be a lot of value to behold. So if 2024 kicks off with a rate reduction in the second half of the year, I think Melbourne's going to change, and it's going to rebound even bigger than Sydney to catch up. But that's a big if depending on when the interest rate going to change. But otherwise, the rental yield is still terrible, unfortunately. But having said that, I mean, that's just, in general, in terms of the market, there's always going to be markets within markets. For example, if coming from a property investor perspective, if I can work through the cash flow challenges at the moment, I actually think it's a great time to be looking at snatching up Melbourne or Victoria assets in general, especially the regional areas, Bendigo, Ballarat, Geelong. There's a lot of available property for sale, and buyer has a lot of negotiation power right now. So if you put cash flow side of things aside, I would say, for investors, don't discount the Victorian market in 2024. It will be a great time to be entering in if cash flow is not an issue for you. You could be looking at subdivision sites. You'd be looking at a lot of potentials at the moment, selling potentially even below land value right now, even below land value. So that'd be where I would be eyeing in particular. But because Perth at the moment, yes, Perth is still fantastic. I would still look at Perth, but Perth's got too much demand. Like, every Eastern Seaboard investor is looking at Perth right now. You're just one of the 10,000s, if not 50,000 of investors that's wanting to be able to put a bid in terms of property. So you got to go counterclockwise to a degree. You got to do something different to others. If you can get something in Perth, fantastic, great. But from a long-term strategic perspective, if you want something that you can do value adds later on, regional Victoria is a great place to look at. Right.
Oh, that's quite specific, but I think it's quite a good tip. That's quite a good tip. Any dark horses or surprises? Any other predictions for next year besides the capitals? So that was a good summary of the capitals. Anything else that you think might happen next year from a real estate perspective?
No, I think that's those. I think those will be the key highlights. To be honest, I think 2024 might not be a very strong property year, in honesty. There's a lot of turmoil in terms of the changes that's been made in 2023, interest rates and all these, 500,000 overseas migrants flooding in all of a sudden. It might not be that much next year, and therefore it's going to be more of a slow and steady year next year, a bit like a sleeping asset in terms of that. You'll probably get a lot more excitement over Bitcoin or gold. Like, gold's been flying at the moment, right? So if you want some adrenaline, go look at something else. But having said that, I do think that 2024 for property market is going to be a slow and steady year, but it's still going to perform relatively well in that case. So like we always do, zoom out, we look at from a 10, 20-year horizon. This is just going to be one of those other years where if you can afford to get in, of course, let's get in. Because, once the cash rate starts to turn, it would change. The narrative would change very quickly again.
Okay. Yeah, I hear you. And interestingly, on the gold thing, gold going up means that in real terms, everything else is coming down. So there's been a very quiet correction in asset prices with the spiking in gold this year, really. So so things do correct in real terms in a more obscure way. So So we might be seeing our Sydney real estate prices head back towards 400 ounces, which means that there's still good value.
True.
All right.
Your turn, John.
My take. So I think, this is hard, right? This is hard because the worst thing about forecasting is that it hasn't happened yet. But so I'm going to say my top performers are Melbourne, and I'm going to say Perth, but it could have been Brisbane. But I'm going to say Melbourne and Perth will be the top performers.
Okay.
Dark horse for Darwin. I think Darwin will be in the top parts, but we'll see. So Melbourne and Perth with a dark horse to Darwin.
Uh-huh.
I think Adelaide will be the worst performer, and I know Adelaide's tight, but it's had a multi-year run up, and I just think it has to pause here for a second. So I'm going to say Adelaide's the worst. Also on the Sydney to Adelaide ratio, Adelaide is starting to look expensive, so I'm a bit surprised it hasn't slowed down already. So Melbourne, Perth up the best with Darwin somewhere there perhaps, and Adelaide the worst. I agree with you on Sydney. I actually think like 3 to 5%, something like that. You can already see it in the dailies; it's slowing right down. But I still think that there's growth in there. I still think that I don't think real estate as a general asset class is as overvalued as it feels. But I think I think there might be a turnaround in interest rates this year. I've always thought sooner than we think, because I always thought that we think it would be right at the end of the year, but I actually think it might be a little bit earlier than that. But putting a time frame on when interest rates will come down is not something I'm prepared to do. But I think it'll be this year.
1.4 this year, yeah.
I think. Sorry, next year.
Yeah.
I do think units will outperform because I think there's so much demand, but I think we'll just usher ourselves into more affordable options. But people will still want to buy. And I'm just trying to think of any other interesting things. It might be a bit more boring. Next year might be a bit more boring, I think. But I don't think we're ready for any crashes or anything like that. I mean, the 18-year cycle suggests that 2024 is a positive year, but I don't want to put too much stock in that because I've been wrong thinking about that one before. So it should be a positive year next year.
Could be towards the later half when there's more interest rate movements. That's where it could potentially,
Yeah, maybe the movements in the second half of the year. That's right. Yeah, yeah. But I think rents are gonna fly. I think rents are gonna keep going.
Can I ask why Melbourne is being one of the top performers in your opinion?
Yeah, because it's starting to look cheap.
Yeah,
affordable. It's been looking cheap for a couple of months now, let's say 3 to 6 months, and it's still it's lagged even more. So when we last did our Sydney to Melbourne ratio, which was based on July data, Melbourne was actually emerging as the cheapest capital, and since and from July to the present, it's just underperformed more. Whereas Perth has sort of maybe done its catch up already. Perth is looking great. The markets that have not done their correction is Darwin and Melbourne. They're currently quite cheap. Now the question is, does it happen next year or does it happen in 2025? And who knows, right? But that's why I'd say Melbourne is looking like the cheapest market.
Yeah, I agree with you on that. I mean, there's a lot of value in Melbourne, that's for sure, moving forward. Yeah, we just don't know when it's going to rebound. We know it's going to rebound at one point, but we don't know when. That's the key.
Yeah, I mean, the only alternative is that people stop moving there, and it's like it's so unattractive from a capital perspective that people are going to stop. But that hasn't happened yet. I mean, so people still want to live there because it's a great city. So long as that happens, when Melbourne prices go up, it's just a matter of time.
Yeah, I think the only thing that would potentially impact the property prices next year will be closely looking at the unemployment rate, basically. Yes. Because when people starts losing their job, that's when things are going to start turn and it's going to become quite ugly. So I think we're still about 3.7, 3.8% unemployment rate. If it goes trending more towards a 5%, it's not going to be rosy at that point in time. And I think one of the reasons why RBA is being very cautious in terms of increasing a little bit every time, and at this rate, is to try to help protect those mortgages as well, in that sense, right? So and also help protect unemployment as well. So try not to try not to basically kill the economy and unemployment at the same time.
And just to finish up on my side, at least with a macro point, the biggest signal in the economy right now is the yield curve. The yield curve is inverted. Yes. What that means is it's essentially a guaranteed recession indicator. So what that means is short interest rates, as in to lend for or to borrow for 1 year, is higher than to lend for 10 years.
Long term,
So you to borrow for 1 year, you're paying 5%. To borrow for 10 years, you're paying 3%. And it's steepening, which means it's getting even worse. The only way they can resolve this is usually it's after the recession happens, but they can just slash short-term rates so that it looks like it's going in the right direction. And that's and a recession. So low interest rates and a recession will fix the yield curve. That has to happen. That's going to happen at some stage. It's tragic, but there needs to be a slashing of interest rates and a recession, and then the yield curve will normalize, and then we're back to normal economic function. But right now, the reason that the economists have been broadcasting a recession for such a long time is that the yield curve has been inverted for a year now. That is highly unusual. So if the yield curve does what the yield curve does, it means it's going to be predicting a recession. So that within 6 months, and so we're kind of there now. That's why I think we're in a recession now.
I think we're already in there, right? But it just depends on how you look at data, like you always do. So we're in a recession on a per capita basis, from memory. If not, it's purely because all that overseas migrant that's coming in, that's kind of like putting it in a positive tone. But cool, awesome. Thanks, John. Anything else to add?
No, but have a Merry Christmas to you and the listeners. Likewise. I look forward to doing this again in 2024.
And Merry Christmas to you and your family as well. Heard you're going to go camping, so maybe you can share some camping tips with our listeners when you come back later on. So
survival, yes.
All right. Well, thank you, listeners, for joining us throughout 2023. It's been fun. I think it's been good. And thank you, John, as well, obviously contributing all your valuable opinions and insights to us. We look forward to doing more of these episodes in 2024. Otherwise, have a good and safe holidays, and we'll see you guys again in 2024. John and David.